Welcome, 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 everyone. We're so excited that you're all here. We have the wonderful Nate Agnini.
That's right.
And he lives in beautiful Santa Barbara, where they have snow. And we have snow. It's very exciting. Wintertime. What I love about well, first I should do a little introduction anyway. So Nate he's a business development officer with his company. They have a fund, which is a private fund. So they lend money to people who are flippers and wholesalers. And we will find out more about that. But what I really love is the way they structure their deals. They do it differently than others. We think it's important to do things differently rather than the same as everyone, because then you're not part of the competition. So Nate, take it away and tell us how great you are.
Thanks, Peggy. I appreciate that. You guys will have to bear with me. I am on the business development side of things, and generally that means I'm at conferences and I'm having this conversation with a beer at a bar and any individual investor. So a Zoom presentation is not exactly my wheelhouse, but we'll see how it goes. In any case, looking forward to talking to all you guys. So Aloha Capital. To give you a quick summary of the two sides of the business, let me start at where it started. So we were founded in 2015 by our two principals, Steve Saphorn and Chris Jones. The company was founded in Hawaii and Maui, thus the Aloha Capital name. Both Steve and Chris come from alternative investment backgrounds. So starting funds, managing different funds, and have been doing so since 1996. Aloha started in 2015 when basically the private lending space opened up to the world. It wasn't really a thing for very long before that. Steve owned some properties himself and was lending money very privately, like his own cash, to investors, and saw the potential in the business. So brought his expertise into fund creation and management into the space, and that's where Aloha launched. So we launched originally as small balance flip lenders. So, to small rehabs, let's say up to $150,000, pretty locally in Colorado, where the company is based now, but in some surrounding states as well. And we did that with a minimal amount of cash from investors to get started. And at the time in 2015, we would originate loans, and we would, let's say they're 12-month bridge loans. We would generally keep them in the portfolio for the duration until the exit on the note, and then churn that capital. We did that strategy for the first couple of years of the fund, so 2015 to say 2017, and then our strategy changed a little bit, but I'll get into that and once we open up the deck and I show you some examples. But basically in its current form, Aloha Capital has two sides of the business. We manage a fund of about $25 million that we've raised from assorted investors, including myself and other people, and the principals still. The fund side of things, which we'll speak about, is fed directly by our very robust loan origination side of things. So we've moved from just simple fix and flip lending into 30-year debt service coverage ratio loans, multifamily rehabs, multifamily purchase. We'll do some ground up development. It tends to be urban infill within the median price of the area it's filling, so not much luxury work, and no real commercial builds as well. So that caps out at about $10 million, those projects for us. But we're relatively unique in the space in that we have a very robust pipeline of borrowers coming to us to borrow money on all sorts of products. We lend in 46 states at the moment, so we serve just about every market out there. So when something dips, something else picks up, and we tend to be lenders there as well. Those notes, to give you a basic rundown of the pipeline and how it works for us, a borrower will contact us. We will underwrite their loan. We'll originate it using our capital in the fund. That note then comes into Aloha and then touches the fund itself. The Aloha Limited Fund is how I'll probably refer to it from now on. That note will touch the fund, and then probably, let's say 85% of the time, we are selling off that note to capital investors in the first month or two of its origination. Often it's not even that long. But we do that for a few different reasons. But the primary reason is that it sells off the back end risk for our investors, because as you can imagine, notes very seldom go non-performing in the first month or two that they're originated. It tends to be later in the lifetime of a loan that something happens, it becomes non-performing. But by selling it off to cap investors before that, we defray that risk and still keep the origination and the yield. Let's see. It's the basic breakdown of how it moves across. I can get into a deck and I'll see if I can share a screen with you. And I think it'll offer a little bit more insight into the Aloha Fund itself and how it works. Let's see, share screen. Stop. Share. Sorry, working on this. Doesn't always work out the way you think it's going to. While I'm getting this loaded, is there anything I can answer for you right now?
Which states are you not in? Because you're in 46 states, so you have 4 that you're not currently in.
Yeah, we don't lend in the Dakotas. We do not lend in West Virginia. We don't lend, actually, I guess it's 5 states. We don't lend in Vermont, and we don't lend in Nevada technically, because you have to have a brick and mortar shop to be a lender there. But we don't have any employees who actually want to move to Nevada to do that. So we hope to change that soon, but in the meantime, we don't offer that. All right, screen sharing. Here we go. Can you guys see that?
Yes.
Okay, so here we are, the Aloha Limited Income Fund. So here we go, an institutional high yield real estate debt fund. So you can see here we are targeting an 8% annualized return. Again, we've been doing this since 2015. The hallmark of the fund is that we would like a very consistent, conservative investment vehicle for our investors, which focuses certainly on yield, but also preservation of capital. It's very important for us to not lose anybody's money. I think that fleshes out in a few different ways, but this graph that I'm showing you here kind of will illuminate a lot of that. So if you look down at the bottom of the graph, so let's say look at 2015, 2016, and 2017, our yields for the year were kind of decreasing from 14, 12, and 10%. And those are in the early years of the business when we held a lot of notes to completion within the fund itself. And, those were, if you think about those years and what interest rates are like, we had a great yield, a great return on those years. But at the same time, when you're holding notes longer, you have a greater risk of default and non-performance. So we switched our strategy after 2017 and then started originating loans and selling them off to our capital partners. So we would take, let's say, that $20 million in capital we had in the fund, and we would churn it maybe 10 over in a year. So let's say we would originate $200 million in loans in any given year. But by selling that off, it took our default rates down to extremely low, way below industry standards, but still let us keep, again, a yield and the origination points on the lending side of the business. You can see the trend, frankly, has been downward, right? So this is our year to date. We target 8%. We didn't do 8% this year. That's just a fact. We did 6.24, 6.3. I can speak to that a little bit. It was a rough year for any asset class, for just about everyone. But although we're at 6.3 and we'd like to be at 8, we're pretty happy with that 6.3. We had a return for our investors every month. We had no negative months. We've never had a negative month. We've had a return for our investors every month since inception at 2015. And if you compare that 6.3% that we did this year to some other some other points, just market points. The S&P was down 19.4% this year, Dow Jones 27.7%, 10-year treasuries down 16%, S&P aggregated down 12%, and Bitcoin, everyone's darling, down 64% for the year. So we're happy to be up 6.3% and returning that to our investors. But it was also sort of the tale of two sides of the year. So the first half of the year would have annualized out at an 8.3% return, and then obviously inflation hit, and the Fed responded and increased interest rates. So it basically shut down borrowers for quite a while, as I'm sure you're all aware of or have heard, at least in the news. There wasn't very much volume going on. So the second half of the year, we would have had an annualized rate of 2%. So that brings us to that 6% average for the year. That said, things have turned around quite a bit. So this is obviously only accurate through December. Whereas if you look at January and February of this year, if you were to extrapolate the annualized return moving forward, we'd be at 9%. So moving forward. So, I think in short, it is a good time to be a bank right now and not such a great time to be a borrower. So because we don't take equity positions on things, we are lenders, we are originating debt. As interest rates increase, while it might reduce the volume that we do, we certainly get a much higher yield on those loans. So if a bridge loan would have been at, let's say, 6% a year and a half ago, that same bridge loan for us now is at 12%. So that allows us to keep a higher yield with the same amount of risk, both to Aloha and then passed on to the investors. Everyone with me so far?
Yes.
Okay. There's a little bit of a illumination on what I was just telling you about. If you were to put $1 into our fund, the month that we started, and that same $1 into the S&P at the same time, we are up over the S&P over a fair bit. That 87% number is actually not accurate. It hasn't been updated. Now it's at 73. So we are up 103% versus the S&P 500 3%. So, eat your heart out, Warren Buffett. This slide talks a little bit about the change in the strategy between the two, not two halves of the time the fund has been in existence, but the strategy. And I'm happy to share this deck with all of you as we get to that point. So don't worry about making very specific notes. And if you have anything that you see that you'd like me to explain further, I'm happy to do so. Right here, it's talking a little bit about how we keep risk from our investors, and we do that by having pretty strict underlying guidelines and underwriting guidelines. While we are private lenders, and I guess technically hard money lenders in that way, we are underwriting our loans for sale to the securitization market. So these are generally Wall Street firms, and they come up with their credit boxes. And while we do keep some of that on our portfolio, generally we are underwriting it for sale. So we do a fair bit of check both on the borrower and the property itself. This talks about that a little bit here as well. So we are by following institutional lending standards, it gives us a lot of options as far as what we can do with those loans. We can either keep them in our portfolio, which is great. We can sell them to our institutional partners, or we can sell them to direct investors, which is something we'll talk about in just a little bit here. These are, a very basic graph of the markets that we lend in, but let's say it's all of the markets. So right now we're doing a whole lot in the lower Midwest and the Smokies and places like that, whereas markets that were red hot a year and a half ago, let's say Phoenix and places like that, don't have as much origination going on. But because we're not regional and we can really work with the trends, it allows us to keep our volume up. Everything we do is a first position loan. So this is the only thing that we lend on, and the only thing that our investors are ever exposed to. So as you can see in this graph, every other position will lose money before first position loan ever loses $1. So it's just another level of insulation against risk. Here's a good example of, again, being the bank versus being a borrower. But, maybe many of you are active real estate investors, and I am myself, and we certainly deal with active real estate investors all the time. And sometimes it's a great time to be an active real estate investor. I think maybe today, not as great as it has been historically, but it's a great time to be the bank, in that you get a lot of the upside of that real estate investment. You can count on the expertise of the borrowers and the people that we loan to and do our underwriting for. But you're not doing a personal guarantee on anything. You get the yield, but you don't have any of the exposure to the risk. This talks a little bit about us versus some other lenders. We're not a big shop. We've got 25 employees. I wear a lot of hats within the company, as we all do. So one of the nice parts about being either a borrower or an investor with us is that when you need to talk to somebody, you can literally give me a call, and much to my wife's chagrin, I pick up the phone almost all the time. So we're a tiny shop, and we like to, it sounds cheesy, but actually build relationships with people, and whether you're acting as an active investor at the moment or a passive investor, we want to have a solution for you and work with you for that. So, nice to know who you're dealing with. This talks a little bit about, the downsides of being a lender. What happens when it goes wrong? First off, it seldom goes wrong. I think that our historic rate of non-performance is 2.4%. Right now, we have I think it's 1.2% of loans over hundreds of loans in the portfolio are non-performing, and that doesn't mean in default. That just means late on a payment for some reason. Maybe it's a flip and they haven't gotten their window package in, and they're not ready to sell at the end of their 12-month term. We have multiple ways to deal with that before it comes to taking over the property: forbearance, foreclosure, and then the end, a creative workout. So it lets us have some options to keep everyone happy, frankly, to certainly keep our investors happy first and foremost. But we're not looking to take over homes if we can help it. In the history of the business, I think now probably 3,000 loans deep or something like that, we've only ever taken over 2 properties. This talks a little bit about the default rate. There you go. Yeah, 1.28% current defaulted loans in the fund itself. And here is an example of the founding team. Again, I mentioned Steve and Chris. Kevin Hill is our COO and CEO, and co-fund manager. So that is the Aloha Limited Fund deck. And while I've got you sharing the screen, I'm going to pivot a bit to what we call the passive note platform. Let me hop out of here and let me get into this. While I'm loading it, can I answer any immediate questions for anybody?
Yeah, well, that was going to be my question, and I still have a question about it. So if you're selling the property or the loans to one of your investors, then that comes out of the fund, right?
To our capital partners?
Yeah, I thought you told me that if I was an investor in your fund and I wanted to buy one of the loans, you would sell me that loan.
Yep. So that is the segue. So
right. That's so exactly then does that come out of your fund? The whole thing comes out of your fund, right? Because that person is getting the full amount of the payment, correct?
So that's kind of a nuanced question. So the fund itself, the Aloha Limited Fund, we don't let loans that don't fit the mandate of the fund touch the fund. So there are loans that we will originate through the origination side of the business that investors aren't necessarily exposed to. Mostly because we want to insulate them from the risk, but also because there's a level of this is a securitized property, so we want to make sure that we are following the letter of the law as far as what our fund's mandate is. That said, because the credit markets have tightened so much on the back end, we are in a place where we see a lot of opportunity to lend that our back end capital partners no longer offer exits for, right? So they will, if you're just a Joe Schmo trying to go do a rehab loan and you haven't done so many times previously, you're probably having a really hard time doing so. They're looking for experience. There's not very much opportunity for back-end exits on ground-up builds for residential properties right now. And then just generally speaking, leverage levels have dropped a lot. Whereas if you were a very experienced operator previously and you could get 90 or even 100% loan to value because you could show excellent FICO and 50 plus exits, that has dropped to, let's say, 80 or 85% loan to value. So it lets people who have fully tried and true and tested business plans, it's really kind of changed the way that they can do business and lever their money and scale. So something that we have started doing is, because we have this very robust network of borrowers, reaching out to specific borrowers that we worked with previously, and they come to us and offering products that frankly don't have a home on the securitization marketplace in Wall Street anymore, and saying to them, listen, we know you're a great borrower. We've worked with you before. You have excellent credit, 750 plus credit, never had a mortgage late. And then your loans, your deals meet a very specific criteria that we're looking for. We will loan money to you out of separate funds, and originate these loans for you. And then we'll keep them on what this is, the passive note platform. So let's look at an example of some of these funds. So this is just sort of, and this is actually not the current version of what you would see live if you were to go to the website, but it will be this week. So I might as well show it to you. This loan, for example, in Kansas City, Missouri. We can click on this and this screenshot, the thumbnailed view of those loans. That's how you would expect to view it. So this loan, this borrower, Andrew, he is a turnkey operator. He's got loads and loads of expertise. He, again, fits the criteria of a kind of loan that we would do. We would loan to him. He originated this loan to us at 13% for a 6-month term. There's origination points on that the lending side of the business keeps. But we then take this note and put it in the passive note platform. We're happy to keep this note on the platform. If nobody buys it, it's got a great yield, it's got a great borrower, it's got an awesome return, and it's we think an excellent loan to have originated. That said, we can offer it to investors like yourself for purchase. So while we originated this note at 13%, we will sell it to you at 12%. And this breaks down some of the information here, so you can see all the underwriting on it. But basically, we obviously identified it, we underwrote the loan, we originated it, and now we will service the entire thing. So in this case, it's a flip, a bridge loan on a fix and flip. So he's going to fix it up. You can see some of the numbers on the ARV and loan to value. But then you can also see sort of what your monthly yield would be as an investor. So if you were to purchase this loan through us on the passive note platform, that would be your monthly return. And that's a passive return that literally comes into your checking account while we service the loan until the date that it's over. And then something Peggy spoke about earlier that this sort of ties it all together. So as a fund investor in the Aloha Limited Fund, so the larger fund with the 8% annualized return, as an investor into that fund, we're allowing you to slide 75% of any allocation you have into that fund into any of these individual notes at any given point. So if you've got $200,000 or $300,000 in there, you can move up to 75% of that cash. And then you can say, okay, I'm looking at the passive note platform over here. I really like this loan in Kansas City, Missouri. I want to fund this note. So I'm going to move our $247,000 of what I have in the Aloha fund into this note for the duration of that note. You will create your own, the rate of return that you see on the note itself will come to you monthly. And that when that note comes to term and they exit out of it, be it sale or refinance or whatever their plan is, your money then round trips back to the Aloha Limited Fund. So it's a relatively unique structure that Peggy was talking about a bit earlier, that it really allows you to choose your own adventure to a degree, whereas you could invest in the Aloha Limited fund itself and shoot for that 8% annualized return in a very conservative, consistent way, totally passive again, only in first position notes. But then if you're feeling like you want to spice up your rate of return, you see a note that you really like, maybe you're a real estate investor and you don't have a project coming online anytime soon, you have money you want to allocate, you can move it into one of these notes and basically be the bank for that period of time and create your own blended rate of return. So it would be very easy to have money into the fund, just generally doing 8%. But then if you're, let's say, moving over half of your funds or your funds half of the year into a 12% note, you're coming up with your own blended rate of return of, double digits pretty easily. The notes on the platform tend to be a little bit smaller. We shoot for kind of $50,000 to $250,000 for any individual note, so that they are manageable chunks for somebody to take down. They are not fractionalized, so it is it's not a situation where you can come in and buy $50,000 of this $247,000 note. You can, however, buy it as an entity. So if let's say this group, for example, wanted to come in together and do an LLC to buy it, that's absolutely fine.
So do you hold that note? Let's say I'm in your fund and I decide I'd like that and I want to buy that note. Now, is that note still held in your fund?
Again, this note doesn't touch the fund itself, because this was originated in a separate vehicle, and it doesn't necessarily meet the fund's mandate. And this note actually specifically might, but we also, we sell some portion of notes that would be like ground up development or something like that. So that would not be something that would ever touch the fund. So I guess the answer is the fund, let's say this note, this Kansas City note, which I actually think is in our fund, it's in the fund. It will be in the fund for the duration of the note's term. We are digitally assigning it to you, so you are the new owner of it, but you would only ever take real possession of the note or the property if it were to come to a workout or a forbearance, something like that. So in the end, it's not taking money out of the fund in any way, if that answers it.
Well, I'm working on the yield that you have. So this is only paying 1% into the fund, right? Because you're selling it at 12% and it's making 13. So that extra 1% goes in the fund, correct?
Yeah, exactly. Because there was also origination points built in with this loan as well, right? So let's say there was 2 points origination, that feeds the lending side of the business. The extra 1% that we keep between the 13 and 12% does go into the fund. And that's how we've sort of built the fund. So rather than keeping notes in there and just saying, okay, we're doing this note's 12%, let's fill the fund with 12% notes and keep them to fruition or till they come to term, that might have a great rate of return, but also exposes our investors to a lot more potential workouts. Whereas if we sell it off, keep, let's say, a 1% spread between what we sell it at and what we originated at, because while we are selling, we haven't done this direct to consumer note sale very often. We clearly have sold like 2,500 notes in the last 6 or 7 years. We just sell them to Wall Street rather than to you.
So I have my money in the fund. I took 75% of it and bought one deal. Where's that money go?
Where does that money go?
Yeah, because it's already in the fund. All I'm going to get is the cash flow out of it.
Yes, so you are exactly.
Still have the same use of the money that you had before. Well, I don't know. That's what I'm.
So we still have the same use of the money. So we still have access to that capital, which is why we can allow the liquidity to do so, because the money's not, it is structurally, it is actually coming out of the fund, because by purchasing that note from us, you then that note is no longer the rest of the investors in the fund are no longer exposed to any risk associated with that note. You've purchased it from us directly. You are the sole, you have the sole position on that note at that point. At the same time, so you're, rather than getting a little bit of the yield, you're getting all of the yield, or 12% of the yield, whereas the investors are no longer exposed to that portion of it. And
right.
That's if a note was in the fund in the first place. Not all notes are.
And you still have use of the money.
Well, no, no, when you wire us money, that goes into a separate structure for the note itself, because otherwise we'd be levering that money. So if that were, we can't take your $247,000 in this place and still go use that cash. I mean, I guess we could, because we have plenty of liquidity to cover it, but instead that cash goes and,
So I have to set, even though I'm in the fund and I have that money in the fund, I have to send you separate money for that note.
no, maybe, and perhaps I'm not explaining that clearly. You move your money across. So if you were in at, let's say we were to allow you to take 100% of the money you had in the fund into a note. You literally move that out of the fund itself, your 247 that you had in there doing 8%, you move it into a note. That note is purchased outright from us. You are getting now 12% instead of the 8% annualized return during the duration of it. And then the agreement is that money will round trip back to the fund itself. You haven't sent in an extra dollar. The only time that you would have to send in more money is if you were trying to purchase a note for
More.
an amount than you have available in the
Right.
fund itself.
Okay. Yeah, I just wanted to understand it. I
No,
want everybody else to understand it.
That's an excellent question. And also that's something important to clarify, is that the fund itself is only available to accredited investors. We have $100,000. Well, generally speaking, we have $100,000 minimum buy-in. I think for this group, we could do less than that. Not that you need less, but we could make it available for less. But that's only available to accredited investors. The notes are available to anybody. Anybody who wants to buy them. So while you do need to be accredited to be in the fund, if you just wanted to pick up a note, you prefer to look at the passive note platform itself and work that way, that's totally fine. What we are trying to solve for by doing the blended principle is that we found that there's just dead money. You could have your money in the fund and doing 8%, and that's great, or ideally 8%. You could have your money in a note doing a much higher yield, but then you would be in a place where you're having to sort of jump from note to note, because while these are 6-month terms on some of these notes, there's no guarantee it will go to 6 months. They can exit out of the loan anytime they want to, right? Anytime they sell the property or refinance out of it. So we don't want you to, be into a note for 4.5 or 5 months, the note sells and there's just not another note on the platform that you want to do something with. And now your money's not making any rate of return. So we would rather you be in the fund and have a nice conservative return going all the time, be able to slide into a note at a much higher yield and then bring it right back to the fund when it's finished. And then at no point was there dead money working. It was always money working for you on first position notes.
Great. And Cliff has a question.
Yes.
Yeah, I've got a few questions. So I wanted to ask, what's the longest term these notes can go for?
It's a good question. So generally speaking, in the Aloha Limited Fund, we're shooting for 12-month bridge notes. So there are, again, when we're talking about workouts and forbearance, and if something were to go non-performing, we can potentially offer extensions to borrowers, but they're 12-month terms. The passive note platform, so these would be notes that we are underwriting and originating specifically for the platform. Generally speaking, those are 6-month terms. They do have 2 potential 3-month extensions. Those aren't guaranteed extensions. We don't have to allow those extensions to the borrower, but they have the potential to do so. They would, if they were to take advantage of that, they would pay an extra origination point that we would split with whoever purchased the note from us. And so in the end, it could be up to 12 months, but that hasn't been our experience of them. Most people are exiting on them a little bit earlier than that, earlier than their 6-month terms. So I guess if it answers the question, 6 to 12 months is the longest hold period that you'd be looking at. It is generally going to be much shorter than that on any individual note. But the upside is that regardless, it's not a big lockup period. And that's something I should talk about with the fund itself. We don't have any lockup. There's no 1-year lockup in it. You have a quarterly withdrawals. We need 45 days notice, but we do quarterly withdrawals of your funds. And so if you know that you are going to need your funds out for whatever reason, give us 45 days before that quarter and you can pull out all of your capital without any additional fees.
So if I bought the note and something happened, would I be able to personally sell that note?
That's also a good question. Would you be able to? Yes, I mean, you own the note, right? So there is nothing legally, yes, you would be able to sell that note. There's nothing legally keeping you to do so. We wouldn't necessarily have anything to do with that. Like, it wouldn't slide back onto our platform as a
Sure.
note for sale. You would have to, you could sell that individually and come up with your own legal paperwork. But yes, I mean, it's a note that you own. It is your property. You can do whatever you'd like with it.
Okay, so title would move into my possession.
Exactly.
Okay, all right, got it. And then when you're actually underwriting yourself, what kind of debt service coverage ratio are you looking for?
Well, so I'm sorry, and if I was pop out of here. Debt service coverage ratio. Most of these again are bridge notes. They're not for long holds, so we're not looking at a lot of DSCR requirements. So the passive note platform does have a 1.15 DSCR requirement in it, and that is more as a fail-safe for our investors than it is for an active exit. For most of our borrowers, they generally intend to sell that or wholesale, whatever it is. If they are going to hold it for rental, then it's obviously nice to know that it has a rental exit, but we built that in there for that reason. So if one of our direct investors wanted to take that note over, they would know that it is a cash flowing rental property, or potentially a cash flowing rental property, assuming that the rehab was finished. While Aloha does originate debt service coverage ratio loans, and we do a ton of them right now, and that's at the same 1.15 DSCR. Those loans, other than being originated out of the fund, aren't stored in the fund at any given point.
Okay, thank you, I appreciate it.
Yeah.
Okay. Does anyone else have any questions about this? I know some of you were a little late, but
That was a lot of stuff.
it was a lot of stuff. Yeah,
Well,
this is really nice. Actually, there's so many different things that could be done with your fund for the investors. So that's unusual also. Usually you're in the fund, that's it, have no control over, have no say, nada. But here's the opportunity to make more of a yield.
That's it. It's one of those positions where it can be as active as you'd like it to be. It's designed to be completely passive. You can put your money into the fund and count on the fund managers and their years of experience to deliver a great return and a very secure return to you, and preserve your capital, which is an important thing right now. At the same time, to your point, absolutely, you can be a little bit more active and choose your yield. Ideally, it's still a pretty passive activity for you. You choose the note, you wire some cash. The whole assignment process takes about 20 minutes. But that said, you don't do anything after that. Again, it's just directly distributed to your checking account monthly. You don't have to manage that note. You don't ever have to talk to the borrower. You don't have to do anything at all. It literally is just coming, whatever that yield comes to your account monthly. And then when they are going to exit out of that note, we let you know that's going on. If you were just investing individually into that note, your cash is wired back to you at the end of it. If you were part of the fund, it gets wired back to the fund, and that happens, and that's it. But it's certainly not something that, unless you are really gung-ho to do so, you have to be looking at on a daily basis.
Great. Derek, looks like you had a couple questions.
Yeah, I was just noticing that he had mentioned that he only does first position loans, and for it seemed like for the security of the for the people investing on buying the note. But I was concerned that, do you feel like there is an opportunity that you could be missing out on by not considering maybe some second position deals? So I was just curious.
Aloha as a company?
Yes.
I mean, yes, in that the world of private finance is a wide and varied world, right? So the amount of lenders, whether they're private or institutional, that lend to all sorts of different debt, it is so much beyond the scope of maybe not what any company could take down, but certainly what a company of our size can take down. So, I think that we've identified what we think is a very lucrative but safe strategy for both our company and our investors by only taking first position loans. Certainly there's opportunity in the second positions and mezz debt and equity positions. You know, there are competitors. You could take your money and invest it into a equity purchase on a development and have a 3-year hold and have, you know, potentially great rates of return. It's just not where we live, you know, where we live doing it. But there's options for everything. So I guess the answer is yes, we are certainly missing opportunity, but I guess we look at it as we're also limiting risk and increasing consistency.
Let me ask you a question based on that question.
Yep.
If somebody came to you that was a flipper, for instance, and they needed more money, but you only do a first position, would you lend them enough they could pay off the first and then they'd have the money they needed to complete the project?
Yeah, absolutely. I mean, they would have to meet our underwriting guidelines. They would
Sure.
still have to make sense across the board. But if we are replacing somebody else's first position, buying them out, and then, you know, sell them. So the sticky part with that would be is we don't generally like to hop in with loans that are, or I guess projects that are midstream, unless there's a pretty good reason they couldn't get it done with their original lender. Like if they were self-financing it and they found that, wow, this is just a different beast than I thought it was going to be, that, you know, it needs foundation work. Or they're just changing the scope of the deal, right? They're like, oh, I'm actually going to put in new windows and a new kitchen, and I don't have the money to do that anymore. Then yes, absolutely happy to buy them out of whatever their current loan is, assuming it meets our guidelines, and fund that. For all our rehab loans, we do purchase and we do 100% of the rehab financed. And we like to do that because it lets us control how the money is distributed. That's through a draw process. So we're not just cutting them a check and saying, here's your cash, go do what you want with it. They have to sort of prove the work has been finished as it's going, and then we'll reimburse them for that. But in the end, it lets us dial in the after repair value. So before they originate the loan, they say this place is worth whatever, $250,000. We know that they're coming up to that number based on what we help them pay for in the purchase price. And then also all of the rehab, which we're financing. So it doesn't let them sort of cut corners in order to sort of keep some of the cash in their pocket. Not that that's people's strategy, but it lets us control things a little bit more.
Thank you. Elijah.
Yeah, I was wondering, would you guys purchase notes as well? Like if I created a note on a property and I wanted to sell out of that, would you guys purchase that and provide that to your investors?
It's not a strategy that we've undertaken before. I guess it's a never say never sort of principle, but it's not something that is built into our framework by now.
Okay.
We have somebody that probably would do that, Elijah,
Okay.
and he'll actually be on next week.
Oh, cool. Awesome.
Give you a reason to come back. Right?
Yeah, absolutely.
There you go.
Any
Yeah, I
other
mean, Elijah,
questions?
if you go find a flip deal that you can somehow originate at 14%, and I'll buy it at 13%, and I'll sell to another investor at 12%, that's great. But those are pretty tough to come by. So
Okay. Yeah. No, absolutely.
Is that it, Elijah?
Yeah, I think so. Yeah, that answers the question.
All right. Derek, did you have another question?
Yeah, I just wanted to ask with the rates changing, with the Fed changing the rates in the market, do you guys anticipate, do you basically just follow the same trend? If the rates go up, then you guys' rates go up as well. So, or is this just kind of just a standard rate of where you're keeping things at?
No, we absolutely are matching the rates of the Fed, which is why rates that we've offered have changed dramatically over the last couple of years. So if you recall that slide and sort of how our yield has changed, a good portion of the return that we offer to investors is based on rates. So in the years when you could go get debt at 3 or 4%, it was obviously a bigger struggle for us to meet an 8% targeted annualized return without changing our principles, and we weren't willing to do so to do that. So it kind of comes into those years we're in the 6s. That said, in an environment where rates have gone up by quite a bit, our rates, I would say, match any changes that, first off, we don't necessarily just change our rates. the Fed changes the rates, prime changes, capital investors follow, it trickles down the line to what we see in our underwriting guidelines and say, okay, this is a rate that we have to match in order to sell it and make money. So to answer the question, yes, we absolutely sort of mirror what's happening in the world of rates, but to be a lender and certainly to be a note buyer, that's not to say it's a good thing, because there's also the downside of higher rates mean less origination, but it makes it much easier to meet the yield return target on the fund. If, typical rates are at 9, 10, 11%, it makes it a lot easier to meet that 8% targeted return. If anything, we hope to, exceed it, but no guarantees.
Does that answer your question, Derek?
Yes, it does. It absolutely does. I guess I just feel like it would be, it's just the rates always make it kind of hard, I would think, for different lenders and private lenders trying to, stay and be competitive, when they're trying to lend money to borrowers. So I just guess trying to get a guideline of, what are you using to just making sure that you're being competitive, so you're constantly attracting new borrowers that want to borrow from you guys.
Yeah, I mean, first off, we're not, there's all sorts of different strategies as to how you win somebody's business, right? And you can certainly just try to be the cheapest in the market across the board, and that's not our strategy. We certainly want to be competitive, but if you search every lender out there, I think eventually you'll find somebody cheaper, and that's totally fine with us. We work hard to be the best. We want to be very high touch. We want to be able to deliver, because I think that you can offer a really low rate, and if that falls apart in the end and that person can't close the deal for whatever reason, you didn't provide a service to them, you made it harder for them. So we find that, generally speaking, our investors are less sensitive to rate than they are to the unknown. So they would prefer, clearly they would prefer lower rates, but if the rates are going to be higher, they just want to know they're going to be higher, and they want to know that we're going to still deliver on what we said we were going to deliver based on those rates. So we bake those rates into the future for us. We want to make sure that we can get from the beginning conversation to close without having to retrade and give them new pricing and have them rework their entire deal to do so. And we want to deliver. We want to make sure that we can get to that closing table for our investors, and they are our borrowers, and they, we are very lucky to be, while a relatively small fish, we punch way above our weight in the private lending space and have a lot of pretty key strategic partnerships. There's a company called Bigger Pockets, which has a very active user base, and we are partners with them. They're also based in Denver. We get a lot of business from Bigger Pockets, but also, we're very active at trade shows and just making sure that people know who we are. And ideally, we're getting a lot of word of mouth reference, and that tends to be the case.
It's great. Cliff.
Yeah, so I just wanted to kind of mention something. So what I'm seeing out there right now for hard money, pretty much consistently, is about 12% plus 2 points. So, that brings it up, above what you're charging, Nate, by the time you put the points on top of it. So it's not cheap money. They know it. And you're right. They just want to know on the front end what the money's going to cost them. So when they do their own underwriting, they factor that into their deal, so they know what they're working with. And that's really the most important part. And I remember, not so long ago, less than 10 years ago, where hard money lending was as high as 16%. Mm-hmm. So, I mean, when you hear 12% right now, that's 12, 13% is pretty much the norm. Mm-hmm. Even 14.
It's something to think about that, I think it's very easy as a standard borrower. Let's say you've got just your personal property, you've got a 30-year loan on it. It's not at 12%, and we're not doing 30-year notes at 12% either. These tend to be fix and flip loans with, relatively short carry times. You're ideally getting this property done in 6 months, and it's not to say the rate is immaterial, because it certainly is, but you're not carrying that rate for years and years and years, unless you've made some really terrible decisions on the line. Like, you are going to either sell that property or refi it. So let's say our debt service coverage ratio loans, which are our 30-year term, 30-year amortization loans, on a fixed cash flowing rental property, those rates right now for us are kind of high sevens, low eights, which is about a point above prime. So, you know, you can always go get it cheaper from a bank, but you can't do it on your 20th property, and you can't do it as quick as we can do it. So there is certainly a niche for professional investors who are looking for this kind of financing.
And you do those long-term loans also?
We do, absolutely. We do tons of them right now. Something relatively unique to us, I mean, there are other people do it, but not many, is we can base that 1.15 debt service coverage ratio threshold that we're looking for either on certainly rent in place. We can do T12, the trailing 12 months of rental income, or if it's a short-term rental application, we can use a third-party software called AirDNA, which basically projects short-term rental income, and use 90% of that number to potentially qualify you for the debt service coverage ratio loan. So you can go and find a cash flowing rental property. Certainly short-term rentals tend to cash flow much better than long-term rentals if they are a little bit more fickle. But we would let you acquire that property at 80% loan to value for fixed 30-year debt, like I said, and kind of that, you know, low eights point at right now, based on short-term rental projections. So that's pretty tough to find otherwise.
But not to an end user, right?
Yes, to an end user like you, Peggy, could go buy short-term rental in Sierra Madre.
No, but I want to live in the property.
No, yeah, it's got to be an investment
no.
property. It cannot be your
Right,
primary.
it has to be an investment property. Just double checking.
Yes.
Okay, no.
Sorry, I'm losing some charge. I had to plug you in. Weird angle.
All right. Well, we're almost done anyway. Do you have another question, Cliff? Does anyone have another question? Well, we are close to the top of the hour, so have you any other comment to make, Nate?
It's been a real pleasure talking to you guys. Those are great questions. I enjoy this more than I thought I was going to.
Well, I'm glad that you enjoyed it.
Being on this side of the screen, so I really do appreciate your time very much. And no, I other than, you know, while it's certainly a volatile period and has been for a while now, there is opportunity in real estate, in the real estate space, and what we're trying to do at Aloha is offer people the opportunity to take advantage of those opportunities, whether it be on the active investing side, and we can help you originate a loan on something, or on the passive investing side and take that money and allocate it and have it work for you in a place that's a little bit safer. So either way, we would love to chat with you about any deals any of you have.
That's great. Yeah, well, I got some ideas while you were talking about this, so you might be getting some referrals. And as always, our last question, Elijah.
Yeah. So I guess one other, you may have touched on it already, and maybe I missed it, but as a buyer / borrower, what is the timeline I can expect to get approved for a loan, pending I get approved?
Well, that's interesting. So because we are generally lending to the asset more than the borrower itself, pre-qualification it depends. It's either instant or it doesn't happen until the loan closes, depending on how you look at it, right? Because I can say, Elijah, are you a qualified buyer or borrower? You may very well be, but because I'm not looking at your W-2s and your debt to income ratio and your tax statements, I'm not worried about whether Elijah has the ability to pay back the loan as much as whether the asset Elijah is borrowing for has the ability to pay off the loan. So if it's a debt service coverage ratio loan, is this a cash flowing rental property? And will Elijah be able to service the debt based on that cash flow? Or if it's a rehab flip, is the scope of the work that you've spelled out and the after repair value that have in mind, is that a real thing? And we do that via appraisal. So part of it is I can offer pre-qualification letters to anybody immediately. Email me and I can email you back and says, Elijah is pre-qualified for $270,000 on this property at this address. And it doesn't, because again, we're not underwriting you, we're underwriting the property. It's not that it doesn't mean anything. It checks the box for the if there's a realtor or somebody involved. But until we actually get that property and start the underwriting and get the taxes and see the scope of work, we're not actually closing that deal until it's finished. So I don't know if that answers your question, but it's
that does.
Okay.
That answers part of it. I guess to add on to that, what about the timeline? I guess I should have mentioned that part too, not necessarily qualify me, but to qualify the property and everything. Is that looking at, like a month, or is that looking a couple weeks? I guess it depends on an appraisal.
If it's a bridge deal, we're trying to close those in about 2 weeks. So a rehab, a fix and flip sort of deal, we're looking for about 2 weeks. Right now our pipeline's very full, so that's probably pushing back out a little bit. Debt service coverage ratio loans, we're shooting for 3 to 4 weeks on those, and that tends to be pretty accurate right now. We do have an express close option on bridge deals, where it's a rehab loan. You're buying it at slightly lower leverage, so there's some equity in the deal to start. We can close on that in as soon as 3 days. We would do a BPO or some sort of desktop appraisal on it. We would likely keep some cash in reserves in the not necessarily the likelihood, but in the event that when we do have the time after you've acquired the property to do the actual appraisal, if that appraisal has not come back at what we all thought it was going to, there has to be some cash in reserves to make up the difference.
Okay. That's super helpful. Thank you.
Yep.
Cliff?
Any prerequisites from an investor? Like, do they need to have any experience with at least 1 or 2 deals in a particular asset class in order for you to consider them? Or is it strictly on the property itself?
Nope. For rehab loans, it's a good question. For rehab loans and particularly heavy rehab and certainly ground up loans, you have to have experience. So multifamily rehab loans have to have experience. Ground up loans have to have experience, or have another guarantor on the loan who has like kind of experience. For 1 to 4 unit single family fix and flip bridge sort of deals, you don't have to have experience, but we have different credit bucket breakdowns. Let's say it's 0 to 2, 3 to 9, 10 plus within the last 3 years, and that would be exits of a like kind deal, whether it's a sale or refi. So we will certainly loan to you if you've never done it before, but you're going to get reduced leverage and higher rates.
Okay. So ideally, how many deals in a particular asset class that they're applying for would you like to see them have an experience when they come to you?
You had 500, but that's not realistic. But
what's a realistic number?
Yeah, I mean,
2 deals, 1 deal, 5 deals.
Once you get past 2 deals, once you're in the 3 to 9 bucket, we can offer the same leverage and rates as somebody with 10 plus deals. If you're at 10 plus deals, now we're in a place where we can start to look at, can we give you higher leverage than, are you then qualified for the passive note platform? So that passive note platform, that borrower has to have had 10 plus exits in order to do it. They have to.
Oh, that's really good to know.
Yeah. And I'll share, and that's something I will sort of finish with, is that, all of this information I'm going to send to you guys, the deck, all the passive note platform, all that. So you'll have you can pour over it all if you care to. But yeah, so a passive note platform buyer has to have had 10 plus exits in a like kind property in the last 3 years.
Thanks. I appreciate that, Nate.
No problem.
Okay, that's really great. I thank you very, very, very much. And I do hope that you will come back again and see us.
It was a total pleasure. I hope you guys have a wonderful afternoon, and good luck with all of your investments, whether they are passive or active, and building your nest eggs.
Thank you so much.
Of course. Have a great day. Thanks for having me. Bye-bye.